$4,200 saved, $94,000 exposed. That's the math of one decision, made 3 springs in a row, in a county where the weather had been kind, long enough to feel like policy. Owen Streck farmed 320 acres of winter wheat in Reno County, Kansas. In the spring of 1974, he was 34 years old, debt-free on the land, and staring at the crop insurance enrollment form the county ASCS office mailed every January. He read it. He ran the numbers. Then he filed it in the drawer. He did the same thing in 1975 and 1976. On July 14, 1977, a hailstorm moved through the eastern half of Reno County and stripped 320 acres of winter wheat 4 days before harvest. 22 minutes. That's how long it lasted over his ground. He didn't lose the farm. But let's back up, because the decision he made in 1974 deserves the same careful attention he gave it then. In 1974, the agricultural economy of central Kansas was running on confidence. Land values had climbed without interruption since the mid-1960s. The Soviet grain deal had moved prices to levels that made the previous decade look like warm-up. Wheat was pushing $4.50 a bushel at times, numbers that rewrote what a good year meant. Farmers who had been conservative their whole lives were borrowing against rising equity to buy adjacent ground, upgrade equipment, expand operations. The Extension Office called it a growth era. The bankers called it an opportunity. At the AICS office in Hutchinson, the staff who processed crop insurance forms were processing fewer of them than they had in the 1960s. Enrollment was down across the region. When the yield history is good and the price outlook is strong and the lender is telling you to grow, paying $4,200 a year for a catastrophe that hasn't arrived in a decade starts to feel like buying insurance on a house that has never flooded. The premium is real. The threat feels distant. Owen had paid off his land in 1971 using his father's estate and 10 years of his own operating surpluses. He carried no long-term debt. He ran a lean operation. He had seen 2 difficult yield years in the previous decade and survived both without significant damage because his costs were low and he owned what he farmed. That record was real. It was also the thing that made it easy to underestimate what a bad year on a bigger operation would actually cost. When the insurance form arrived that January, he read the numbers carefully. Base premium for 320 acres of winter wheat at standard coverage, $4,200. He wrote that on a notepad. Then he wrote the rest of what he knew. His average yield over the previous 8 years, 41 bushels per acre. County average, 38. His ground was well drained, slight elevation on the north end, consistent soil structure. In the 2 worst years on record for the county, 1965 and 1968, his yields had come in at 28 and 32 bushels. Below his average, not catastrophic. He wrote down the exposure. A total loss on 320 acres at 41 bushels per acre at the current price of $3.10 per bushel was roughly $41,000 in gross revenue. After backing out seed, fertilizer, fuel, and the herbicide already applied, his net exposure on a complete crop failure was $27,000. So $4,200 per year to protect against a $27,000 event. He wrote down the frequency. Severe hail events causing total crop loss in central Kansas historically ran at roughly 1 significant event per county per decade. Per individual farm, the odds were longer, maybe once in 15 or 20 years if you were unlucky with storm tracks. Expected annual cost of being uninsured at a total loss event once every 15 years, $1,800 per year. Premium, $4,200 per year. The premium cost more than twice the expected annual loss. On a pure expected value basis, the math said to decline. Owen was not careless. He was optimizing the wrong variable. He kept the $4,200. At the elevator in the co-op and the hardware store in Hutchinson, this was not an unusual position to hold. Most farmers he knew carried insurance on equipment loans because the bank required it. Crop insurance was a different conversation. A man named Lyle Beckford, who farmed 480 acres east of town and had been doing so for 30 years, said it plainly one morning in February. Insurance is a waste in a good year, And we've been having good years. Nobody disagreed. The room didn't need to disagree. The room remembered $4 wheat in full bins and land appreciating at rates nobody had planned for. The idea that a season could simply be erased, that 22 minutes of weather could undo 8 months of work, was not impossible in the abstract. It was just remote. Remote enough that $4,200 felt like a high price for something that happened to other people. In other counties, Owen filed the form in the drawer. He did it again the following January, and the January after that. By the spring of 1977, he had saved $12,600 in premiums over 3 years. His operation had grown. He was now farming the same 320 acres he had always farmed, but his operating note for the season was $38,000. Seed, fertilizer, fuel, herbicide, and a cash rent payment on 80 acres he had picked up from a neighbor who'd relocated to Wichita. He had not updated his exposure calculation. If he had, it would have looked like this. Gross revenue exposure on a total loss, 1977, 320 acres plus the 80 rented acres, 400 acres total, at 41 bushels average at $3.40 per bushel. That's $55,800. But the operating note was the real number. He owed $38,000 that was collateralized against the standing crop. If the crop failed, the note didn't disappear. It just had no source of repayment. The bank would extend, or it would not. He would negotiate from a position of zero harvest, or he would not. And his total out-of-pocket exposure, the gap between what he needed and what the ground would produce, was $94,000, not $27,000, not the number he had written on the notepad in 1974, $94,000. 3 years later, on a bigger operation, with a standing operating loan, in a year when wheat was $3.40 and every acre mattered. He had never run the calculation again. The storm came from the southwest on a Tuesday afternoon in July. The radio that morning had mentioned possible thunderstorms in the area. It had not mentioned hail. Owen was running a parts errand in the north end of the county when the first stones hit the windshield of his truck. He pulled to the shoulder and watched. 22 minutes. The sound on the truck cab was continuous. When it stopped, the fields along the road looked wrong in a way that took a moment to process. The wheat heads that had been 4 days from harvest were on the ground. Not bent, not damaged, gone. Stripped from the stalks and sitting in the mud between the rows. He drove home without stopping in town. He walked 1 row on the south end of his ground and didn't need to walk another. The 400 acres were a total loss. He called his lender that evening. Ed Brower at Farmers State Bank in Hutchinson had managed Owen's account for 6 years without a difficult conversation. He listened to the whole situation. Then he asked the one question that mattered. "What's your insurance position?" Owen told him. Ed didn't say anything right away. "We'll need to restructure," he said. "Now here is the comparison that matters." Lyle Beckford, who had said insurance was a waste in a good year, carried full crop coverage. He had said that in February and meant it. Insurance was a cost he accepted, not a value he celebrated. He had paid $4,200 per year for 3 years. He had paid $12,600 in premiums for the same 3 years. Owen had saved the same amount. Lyle's hailstorm indemnity payment for the 1977 crop, $79,400. Net position after 3 years of premiums and 1 total loss event. $79,400 minus $12,600 equals $66,800 in his favor. Owen's net position after 3 years of saved premiums and 1 total loss event, $12,600 minus $94,000 equals negative $81,400. The gap between those two numbers, $148,200, is what the asymmetry of tail risk actually looks like when it lands. This is what insurance is, not a savings mechanism, not a bet you hope to win. It is the purchase of a specific guarantee that a low probability, high magnitude event will not end what you spent years building. The premium buys the removal of one catastrophic scenario from the range of possible outcomes. Owen had priced that removal at $1,800 per year in expected value. The actual removal cost $4,200 per year. The difference was $2,400 annually, or $7,200 over 3 years. He had kept the $7,200. The hailstorm cost him $81,400. The restructuring with Ed Brewer took 3 months to negotiate. Owen's land was debt-free, which gave him a position. He pledged the home quarter as additional collateral on a restructured note that extended the 1977 operating debt at a rate 2 points above prime. He planted the following spring on borrowed money at terms he had not expected to carry. He was not ruined. The operation continued. By 1981, he had paid down enough of the restructured debt that his balance sheet looked something like it had before July 1977. He carried crop insurance from 1978 onward every year without revisiting the expected value calculation. He didn't need to revisit it. The 1977 event had told him what the calculation had missed. What the calculation missed was this: expected value works when the outcomes are recoverable. A below-average yield is recoverable. A partial loss in a bad year is recoverable. A total loss on a leveraged operation in the 4th year of a growth cycle, when your operating note is $38,000 and your crop is collateral and your lender is watching 100 other farms in the same county, that is not recoverable the same way. The math was right about the probability. It was wrong about what recovery from the tail event would actually cost. Owen Streck farmed that ground in Reno County for another 28 years. His daughter farms it now. He carried full coverage every season until he retired. He told a story once to his son-in-law who was starting out and wondering whether to pay the premium. He said, "Run the number on what you owe, not on what you own. That's your exposure, not the crop value, the debt behind it." His son-in-law paid the premium. There is a specific kind of financial error that doesn't feel like an error when you make it. Owen's 1974 calculation was correct. The math was sound. The historical frequency of total loss hail events in Reno County supported his conclusion. The premium genuinely cost more than the expected annual loss warranted. What went wrong was not the calculation. What went wrong was that he stopped calculating. His operation grew. His operating note grew. The 80 rented acres added exposure. The crop price shifted the revenue number. Every one of those changes moved the tail risk exposure upward, and none of them triggered a return to the notepad. The number from 1974 sat in his memory as though it were permanent, the way a fence line is permanent, or a property boundary. He had done the math. He trusted the result. He didn't notice the question had changed. Anytime an operation grows, the insurance decision needs to be run again, not updated. Run again from the current numbers. The exposure that justified the original decision to decline coverage is not the same exposure that exists after 3 years of growth. They look similar from the outside. The premium is in the same range. The form arrives in the same January envelope. But the number at the bottom of the calculation, the net exposure if the tail event actually arrives, may have doubled. Owens had. He found that out in 22 minutes on a Tuesday in July. One question worth leaving with: would you have skipped the premium? And a follow-up worth writing down if you're farming or running any operation right now. When did you last run the insurance calculation? Not update it. Run it. From this year's debt load, this year's operating note, this year's revenue at risk. The number you got 3 years ago is not the answer to this year's question. He didn't lose the farm. He lost time.